This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Claremont.
Hello. Welcome to Clear Money Talk. I am your host, Tim Claremont, CEO and founder of Clear Financial Partners, here with our co-host, Tyler Andrews. Tyler, say hi to our audience.
Hello, audience. I'm laughing because every podcast Tim goes, Tyler, say hi to the audience. And that's my cue to say hi to you guys. So
That's
hello.
Great. Next time I'll just point at you and then I won't have to tee you up like that. No, that's funny. Yeah. It is what it is. Like, how do you introduce a podcast? That's
true.
Is what
I
it
can't
is.
wave, I can't shake a hand or fist bump or elbow bumps are a thing now after COVID. So.
Those nonverbals are lost. So
they are.
So yeah.
So
instead we say hi.
We are video recording nowadays, though.
We are. One of these days, I expect the quality of our video recording to actually be worthy of your choice to watch it. But for now, if you just want to see the raw footage of us having a conversation right before the podcast and recording the podcast, and then afterwards, you can watch those videos. They're there for you to check it out if you enjoy the visual experience of it.
Yeah.
For those of you who are watching it, I'm waving at the camera now. So let's go on to the podcast. As far as the question for today, over the years, 26 years of doing this, there are certain questions that a lot of clients will ask, over and over again. Not the same client asking multiple times, but also new people coming in, always driven to try to get an answer to these questions. And the question for today is definitely one of those, which is, hey, Tim, how do I pay less in taxes legally? That's the question. That's the question that we're answering today. And a lot of the clients that we've met, especially as you reach higher levels of success, you start making over 100,000, 200,000, 500,000 a year, whether it's as a self-employed individual or a business owner, or whether it's as an employee where you've just hit higher levels of success, you start to realize real quickly how expensive that tax bill is every year. For many people, it's their largest expense. If you look at your total gross income for the year and you look at everything you spent money on, and if you look at taxes as an expense, it's very possible you spent more money in taxes than you did anything else for the year. So how do we legally reduce that tax bill? And with that in mind, I figured we'd teach you a little bit today about 3 ways to beat taxes. When I was 21 years old, getting right out of college, wanted to be a tax attorney, I remember being taught by the financial planning company that hired me at that time 3 ways to beat taxes. And we're going to go through those 3 ways for you. Over 26 years of doing this, I just haven't found a better way to articulate the simplicity of beating taxes. Those 3 ways are pretty much inclusive of just about everything. Everything fits into one of these 3 categories, and then you can dive deeper into other specific examples within these categories. But these are the 3 main categories everybody should be aware of. So ways to beat taxes legally, you're dealing with the 3 main categories of tax deductibility, tax-deferred growth, and tax-free access. Now, if you had any kind of investment that had all 3, frankly, it's probably illegal. I don't know of any way to have all 3 in one investment strategy, but there are many strategies that actually have 2 of those 3 choices. And that's, it's up to you to take advantage of the various strategies that are out there. Before we go into this, maybe some examples of strategies and things like that, let's just kind of talk about the basics of what they are. So tax deductibility. Tax deductibility is when you have an income that's coming in. Let's say you make $100,000 for the year, and you got to pay taxes. At the end of the year, you pay your income taxes based on that $100,000 of earned revenue. And at the end of the year, you have to do what's called a true up. That's when you file your tax return. Basically, what happens, the IRS says, look, you prepaid an estimated amount of money that you're probably going to owe us at the end of the year based on how much you earned. We want to compare the estimate to what you actually owe and see what that difference is. And if it turns out that you overpaid, we're going to give you some money back. That's a refund. Turns out you underpaid, you're going to owe us some extra money. That's where you got to pay that extra money on April 15th or whenever you file your taxes. And consequently, that's really what a tax return is. It's just an annual true up to determine, did you prepay adequately for your anticipated final bill for the year? But if you could reduce that final bill for the year and pay less in taxes, that's one of the ways to beat taxes legally. So tax deductibility is a way of saying, look, when I go to do my true up at the end of the year, instead of $100,000 of a taxable income, What if I was able to legally erase $10,000 of that and only pay taxes on $90,000? Well, that would mean that you would save taxes on the $10,000 that you were able to earn that you didn't have to pay income taxes on. And that's what tax deductibility is. So if you're dealing with, for example, a tax deduction, often referred to as a tax write-off, right? It's not free, by the way. It's not like the government pays for the whole thing for you. When somebody gets a tax deduction or a tax write-off, it's not like it's just free money from the government or free money from their corporation. That's a common misconception that happens out there. It just means that they were able to erase that money on their annual calculation and save whatever their coordinating tax bracket was. So in other words, whatever the tax bracket rate was for them that they were in, they were able to save that much off their tax bill. So let's say that you're in a 24% tax rate federally, plus a 9% tax rate in the state of Oregon, as an example. If you're in Washington listening, you have zero income taxes. Of course, there's other taxes you deal with. And if you're in California, you're probably closer to 10. Other states have different income tax levels, but for Oregon, it's 9%. So 9% plus 24, that's 33. It's nice, clean, easy third. So if you had a $10,000 tax deduction that was legal, you just saved yourself about $3,333 off your tax bill. So that tax deduction was valuable to you. How valuable was it? Depends on the tax bracket that you're in. So that's what tax deductibility is. And there are several different tax deductions that are available. We can talk about some of the basics that are out there. If you itemize your deductions, you're able to do that. You can write off up to $10,000 of property taxes and state income taxes each year, as well as your interest on your home, charitable contributions, but only to the degree that they exceed something referred to as your standard deduction. So again, I'm not an accountant. I can't give you tax advice. I'm just teaching you some of the basics out there. And there are other tax deductions as well. If you own a business, you can write off various expenses for your business because they're directly related to trying to increase your revenue. If you don't spend the money on that expense, then your business probably doesn't generate revenue. Therefore, that's a legitimate expense. So you have to figure out, okay, what are those legal business deductions? You can increase deductions there. And of course, qualified retirement plan contributions, 401ks, traditional IRAs, any SEPs and simple IRAs. Those kinds of qualified retirement plan contributions are also pre-tax contributions. So those all fall under the category of tax deductibility. What's the second category? Any guesses, Tyler?
Tax deferred growth.
Tax deferred growth. He's watching me. He's like, Tim, okay, now I get where you're going.
It's not like you just told us or anything.
That's true. That's true. Tax deferred growth. Tax deferred growth. So tax deferred growth. You want to give it a shot?
I would love to give
Go
it a
for
shot,
it, Tyler.
Tim.
Tell
Tax
the listener.
deferred
They're
growth.
tired of listening to me. Let's listen to Tyler. He's younger. He's a good-looking dude. Go for it.
Yeah, I appreciate that. Well, only if you're watching on the camera right now. If you're just listening, you have no idea. So.
That's true. But now you know because I told you. So
That's true. You got to trust what he's saying.
Go ahead, Tyler.
Tax deferred growth. In the simplest terms, Tim, the tax deferred growth is being able to invest money into a vehicle. When I say vehicle, that's some sort of investment asset, something like that, and generating returns on that asset, that investment, and not having to pay taxes, whether that's income taxes or capital gains taxes on those returns on a year-by-year basis. You're able to defer or basically kick the can down the road on having to pay those taxes. And what's the benefit of that? Well, it's like, that sounds great, Tim and Tyler, but I'm eventually going to have to pay taxes on that. So what's the benefit to me doing that right now? Well, you're able to compound your returns on those investments a lot quicker, right? So if we look at a tax equivalent yield on an investment that's taxable versus a tax deferred vehicle, your returns in a tax deferred vehicle will actually be higher on a year by year basis, opposed to if you were in a taxable investment and you're having to pay taxes on those returns on each year as you go. Retirement accounts are a great example of that. IRS says, we want people to save for retirement. We don't want people destitute when they reach retirement and stop working eventually. So we're going to incentivize them to save for retirement because pension plans, things like that are becoming less common over time. And it's more on the individuals like us to save for our retirement moving forward. So they try to incentivize that by offering tax deductions for contributing to these retirement plans, which is what Tim was just talking about. They also try to incentivize by saying, if you invest in these specific type of accounts, we're going to let you have tax deferred growth on those investments to, basically multiply your returns quicker than if you were in a comparable account that is taxable. And that's like you're saying, that's one of the main, another way to, quote unquote, beat taxes, if you will. But
Yeah, no,
Shed more light on that. I want to hear what you have to say on this. Obviously,
No,
too.
I appreciate you sharing that, Tyler. Sometimes people learn better just hearing from different people in different ways, and so it's healthy that we have two ways of articulating this stuff right now. Some people are going to connect with your methodology, and others will connect more with mine, and that's great. And for many of us, we'll get insights from both of what we share. So, tax-deferred growth, and you were spot on with everything you articulated. I think the easiest way to visualize it is to go back to those simple numbers we were talking about before. So, if we had $100,000 of income before, and we talked about $10,000 not being not being taxable, so we were only paying taxes as if we earned $90,000 in that example. It's the same kind of thing. Imagine you had $100,000 in a tax-deferred growth vehicle, like a 401k or an IRA or any other kind of qualified retirement plan account, and you earned theoretically a 10% rate of return. So at the end of that year, that $100,000 grew to $110,000. Well, that $10,000 of earnings, if that was in theoretically a bank account or a CD and not a retirement account, you'd have to add that $10,000 to your income for the year. You get a 1099, you have to add that $10,000 on top of the other taxable income you have, and you have to pay taxes on it, which means if you're in the same tax brackets we were talking about earlier, that's about 33%. So it would cost you about $3,300 in taxes if you earned that money in a CD. And then the net effect of that is now you have $3,333 less of the $10,000 in earnings, so you only have $6,667 left to earn interest on the next year. So it's kind of like growing corn in a wheat field, and just every year you're just chopping that tree down by a third, and so it doesn't have as high to grow. Alternatively, God, if you're going to grow corn in a wheat field, you're probably not a very good farmer, I guess. But by the way, I'm clearly not a farmer here. So,
that was a good analogy, though. He just came up with that off the top of the dome. That was good.
Imagine you're growing something that's much smarter than corn in a wheat field. Maybe wheat in a wheat field or corn in a cornfield. But my point is, if you cut off a third of it each year, you got more room to grow each year. You're not getting it as high. Now, on the other hand, what if that is all allowed to grow and just keep growing each year, and nobody's going to cut it down at all each year? That's what tax-deferred growth is. So now that second year, you got $110,000 in there instead of $100,667. And if it earns a 10% hypothetical rate of return, by the way, we don't have anything that's giving guaranteed 10% rates of returns. That's not out there yet that I know of. But my point is, if you earn 10% on a balance that at the end of the first year is at $110,000, and nobody cuts that wheat down, nobody cuts that corn down, then you're going to end up having $121,000 at the end of year two. If you get that hypothetical 10% rate of return, you get a full $11,000 of interest. You're earning money on the money that would have otherwise gone to the government. Alternatively, if you chopped a third of it off and you had $106,667, then at the end of the year, you only got 10% on $106,000, meaning you got $667, I guess, added on top of that. So you're only at about $117,000 versus $121,000. So you're losing $4,000, and that growth on the money that would have otherwise gone to the government is continually being chopped every single year. So the longer you have to allow that wheat or that corn to just grow without it being chopped down, the taller those stalks get. And you can do that. The younger you start doing that in your 20s or your 30s, you can allow that 401k retirement account to just keep compounding all the way into your 60s. You could have 20, 30, 40 years of growth where nobody has taxed it yet. And that allows that forest to just go crazy and bloom. And then you pay the taxes later when you go to take it out. Unless you have the third way of beating taxes, which is tax-free access. Right. So what if you get tax-deferred growth where you're growing that giant forest of all that corn or that wheat, and then you go to dip into it down the road and you still don't have to pay taxes on it? That's pretty cool.
That sounds pretty good. How do we do that?
That's tax-free access. You get that in a Roth IRA. You can get it in Roth 401ks. You get it in 529 plans when the money's used for college education. And you can get it in a LERP strategy, which we talked about recently as well, life insurance retirement plan. If you can get tax-deferred growth on your money, meaning nobody's chopping the wheat down every single year, and then still access that money tax-free later on so you don't have to pay any taxes on it legally when it comes out, that's the third and final way to beat taxes. So it's either tax deductibility, tax-deferred growth, tax-free access, or some combination, typically not more than two of those three. And each one of the investment strategies out there have different pros and cons when it comes to taxes.
Yeah, no, that's well. Should we go more into detail on the third buckets, the tax-free access? And obviously, like you said earlier, there's no investment that we know of that has all three of these categories, but definitely some of the two, like you said. I'm trying to think if I can think of anything that would have three. I just really don't. I know that 529 plans, some states offer a tax deduction for making contributions, but that's also just at the state level.
Actually, but that is a good example. So at a state level, Tyler, that's a good point. So if you get a tax deduction, for example, in Oregon, you get a tax deduction. I think it's either up to $2,000 to $5,000, something like that per household if you qualify. Then you're not paying that 9% state income tax rate on the contribution that goes to the 529 plan. You are getting tax deferred growth, meaning in Oregon you're not paying taxes on the growth of it. And when all that money comes out later on, it's also, if used for qualified education expenses, tax free, at least in the state. So you're actually correct. There is an example of one type of investment that has tax deductibility, tax deferred growth, and tax free access. And that is a 529 plan if you're in a state where that state plan allows a tax deduction up to the degree that it is deductible.
Correct.
Admittedly, the feds are not giving a tax deduction on that contribution at a 529 plan. So your federal state tax or your federal tax bracket, you're still going to pay those taxes. But at least at a state level, there is a real example of that.
Yeah, that's pretty neat.
And there might be some other really creative tax strategies out there. I mean, again, I'm not an accountant. I'm not here to give you tax advice. We're just talking about some of the basics of some of the taxes and how we factor it in to our retirement income planning. When we're doing retirement income planning, you got to figure out, how much do I put into a traditional 401k versus a Roth 401k? How big should my 401k get? If it gets to a certain size, am I using too much money in that pre-tax capacity? Do I need more money tax-free? What if all my money is tax-free? Is that smart or not smart? You would think it's smart, but then again, maybe it's not. Maybe there's a more efficient way to do that kind of planning because you had to pay taxes on the money up front. So integrating all of those answers into our planning is a big part of what we do. And the taxes are different in your accumulation years where you're building your wealth and you're trying to make contributions and you're looking at your income, you're trying to save taxes each year as you do your true up at the end of the year versus when you go to take the money out. Now you're in your 60s or your 70s or your 80s and you have to deal with what are the tax implications on your income taxes, both at a federal and potentially state level. What are the tax implications on your Social Security? They have their own tax bracket. It's called provisional income, and it's a completely separate bracket from capital gains and normal income taxes to determine if your Social Security is tax-free or 50% taxable federally or 85% taxable federally. And that's a whole other thing to factor in. And then in addition to that, you have the Medicare surtax. If your income gets high enough, you actually have to pay extra money each year for your Medicare. And it's the same health insurance benefit that everybody else gets, but it just costs you more if you make more money. You got to pay this extra surtax on top of that, this extra Medicare premium. And paying attention to that as well also comes into play. So you got to watch all these numbers when you go to take money out in retirement. And then, of course, the required minimum distributions. If you're in your 70s, that can have a penalty tax if you don't take out enough money. So how do you do that in the most tax efficient way? So taxes are a big part of our retirement income strategy. And then the final tax is, of course, your death tax or estate tax bill. If you pass assets on to the next generation, the state of Oregon is, I believe, the worst state in the country for death taxes, for estate taxes. And everything over $1 million can get hit with estate taxes in Oregon. And that's a very, very low threshold. I don't know of any lower threshold in the United States. So if you have more than $1 million, and think about the value of your house, think about your retirement accounts and everything else. If you have more than $1 million, and you live in Oregon, you very likely have an estate tax issue that you need to give consideration to. And then that's just a big fat chunk that they're going to take right off the top when you pass that asset on to your kids or your grandkids. So see this stuff coming, have a plan in place. So that's what we do, and keep that tax bill as minimal as possible legally.
Yeah, no, I like everything you said, Tim. I think taxes are not a fun topic for a lot of people, and some of this stuff just isn't fun. I mean, we find it fun, we find it interesting, and there's ways to benefit from all these things that are out there. There's laws and rules that our government and other bodies have created for people to use, and it's out there for us to use, and a lot of us don't know how to use it. So finding the right people to help you build a good plan, build a good strategy is step one. And once you do that not fun part, it's a lot easier moving forward just to follow that plan, and you don't have to talk about it every day if you don't want to, because like a lot of people think it's not fun to talk about it every day, but do the heavy work up front, and then it'll be a lot easier moving forward. And finding the right people to team up with to help you with that stuff is a good place to start. We're always happy to talk to you guys. You can reach out to us, 503-579-1000 is our office number. We don't give tax advice, but we can help on the financial aspects of all that stuff. And, we stand ready to talk to you guys whenever you're ready for it.
Yeah, retirement income strategists. I mean, I think you'd be hard-pressed to find people that are better at what we do. There might be a few that are as good as us, but we're pretty good. So we really focus on making sure you're optimizing your retirement income plan. And if it's the right fit, if we're the right people for you and you're the right people for us, then we want to take care of you for many, many years to come. So hopefully give us a call and get introduced to us. Look forward to getting a chance to get to know you a little bit. As far as the Just the Answer recap,
here we go.
For those that are listening to Just the Answer, how do I pay less in taxes legally? The quick answer and the recap for those that listen to the full thing. 3 ways to beat taxes: tax deductibility, tax deferred growth, tax-free access. Tax deductibility, legally decrease how much you have to pay your taxes on each year. Take advantage of the tax deductions that exist in the tax code and make sure you're optimizing those to pay the legal minimum each year on your income taxes. Tax deferred growth, if you make the money each year, ideally, let's not have it cut down every year by having taxes paid every single year on your earnings. Instead, allow your earnings to keep growing and compounding internally without having to pay the government. You get to earn interest on what the government would have otherwise collected from you. And that's how tax-deferred growth can get to such a large amount of money. And then tax-free access. If you dip into that bucket of money down the road and you still don't have to pay taxes on it, that's tax-free access. And there are excellent strategies and ways to beat that. So the quick answer: tax deductibility, tax-deferred growth, tax-free access. Those are the 3 ways of beating taxes. And we're happy to educate you further on other options and help you strategize the best way to legally minimize your taxes.
That was really good.
Yeah,
that was one of the more concise Just the Answers we've had.
Well, there we go. Well, maybe people might need to listen to it twice.
Yeah, well, feel free.
Go back and let's do it again. All right, for today, to finish us off today, Stump the Nerd. What do you got? What do you got for me?
All right, I got a few for you. So we're going back to acronyms. So I find acronyms interesting. We use acronyms all the time, and sometimes we don't even realize that we're using an acronym. It just sounds like a word at this point. But some of those things are acronyms. And speaking of one of them, I wanted to use this one first. What does EPCOT stand for, Tim?
Ooh.
And when I say EPCOT, I'm talking about Disney World.
Oh, wow. I didn't even realize it was an acronym.
Exactly.
That's really
it just
cool.
Sounds like a word almost.
Wow. Oh, man. EPCOT. Yeah. Like it stands for eating a lot of food. That's what it stands for. Yeah. No. Holy cow. I don't know. Maybe the C would be countries. I'm guessing. I'm just trying to think of all the different countries that are represented and the foods and everything else. I'm surprised that it's not like countries of the, but then there's like no thing after the T. So like the world or something like that. I don't know. Yeah, I have no clue. I would just be making stuff up that goes with an EPCOT. Right. So give it to us. You stumped the nerd. What do you got for us, Tyler?
Experimental Prototype Community of Tomorrow.
Wow. Yeah. Experimental Prototype Community of Tomorrow. That's what EPCOT stands
heavy
for.
Stuff right there.
Wow. What does that have to do with food? I just keep eating every time I go to EPCOT. I just eat around the world over and over again. That's all I think of when I think of EPCOT. But yeah, I guess they had the that really cool car drive thing that's got the where they're doing this crash test dummy stuff and there's like the big Beyond Tomorrow big thing in the ball itself where you sort of get to see the evolution of technology over time. So that'll be fun. I know Tyler and I are going to get to go there shortly. By the time you're hearing this, we will probably have already recently been.
That's true.
And looking forward to eating around the world mostly. But I'm sure we'll check out the other stuff too. So.
Yeah. Okay, I got one more for you.
All right. What else you got?
I think you're going to hit this one in the head.
All right.
What does the acronym JOMO mean? JOMO.
JOMO.
I'm laughing right now because we use another acronym that's similar.
Well, FOMO, fear of missing out, of course. JOMO, the joy of missing out, I guess, because you missed out on something bad.
Yeah, that's what it is.
Is that what it is?
Yeah,
JOMO?
it is. And I heard this recently, and apparently, the millennials or whatever are starting to use this now. And here's the definition. It is a pleasure derived from living in a quiet or independent way without feeling anxious that one is missing out on an exciting or interesting event that may be happening elsewhere.
Ah, the
So
antithesis of FOMO.
our introverts are having JOMO. They're like, I don't care. I'm cool sitting in my room at home.
Oh, that's great. Well, good for you. Well, I hope after having listened to this, you certainly do not have FOMO because you just got a chance to listen to this podcast today, and I
Nice.
hope you're leaning into your JOMO as you wrap up today's Clear Money Talk. So, thanks for joining us.
Thanks, everybody. Till next time.
Investment advisory services are offered through Clear FP Advisors, LLC, or registered investment advisor. Securities are offered through Clear FP Securities, LLC, member of FINRA IPC. Exposure to ideas and financial vehicles discussed should not be considered investment advice or a recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments may fluctuate and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Timothy Claremont is licensed in your state, please contact his office. Clear FP Advisors, Clear FP Securities, and Clear FP Life LLC are not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide tax and/or legal advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Clear FP, LLC NPN number 194283777 and/or Clear FP Securities NPN number 197499604. Any discussion of general investing strategies or specific securities are for conversational purposes only and should not be taken as a guaranteed endorsement or recommendation.